Most people spend their whole career working for money. 40 hours a week, 50 weeks a year, decade after decade, chasing it, holding on to it, hoping there's enough left over. And almost nobody stops to ask the real question. When does money start working for you? Eli did. He just got $900 from a work bonus, and he was about to put every dollar of it to work. My name is Nathan, and in this video, we're walking through exactly how dividend investing works, starting with just $900. You'll see how Eli picks his stocks, builds a real portfolio, and what happens when you stretch that out over decades. By the end, I'll show you how that $900 turns into a portfolio worth over $330,000, paying more than $4,400 every single month in dividends. But first, let's talk about where Eli actually started. He had a steady paycheck, but nothing invested. His friends were spending theirs on new phones, weekend getaways, stuff that feels great for 2 weeks, and then vanishes. Eli watched all of it and felt something different. He didn't want to blow this month's money. He wanted to build something that would still be there years from now. So why didn't he start sooner? Honestly, it's the same reason most people don't. They figure their money's fine, sitting in a savings account, because the number on the screen never drops. But fine and growing aren't the same thing. Every year, inflation quietly eats into what your money can actually buy. Back in 2020, prices were barely moving, up around 1%. By 2022, that number had rocketed past 8%, the worst it had been in over 4 decades. Groceries, rent, gas, all of it spiked. Things have cooled off since then, sitting around 2.5% now. But here's the catch. The average savings account still only pays out a fraction of a percent. So you're quietly losing ground every year, even while your balance looks untouched. Picture this. A grocery run that cost you $200 in 2020 now runs you closer to $250. That's an extra couple $1,000s a year for the exact same cart of food. Stack that on top of rent, gas, and insurance, and you feel it everywhere. Letting $900 sit idle isn't neutral. It's a quiet decision to lose value over time, even if it doesn't feel like one. That's the moment it clicked for Eli. His money wasn't safe. It was shrinking. So he stopped waiting. Now, can you really do anything meaningful with just $900? Yes, and here's why people underestimate it. First, fractional shares change the game. You don't need to buy a whole share anymore. If a stock costs $500, you can put in $50 and own a slice of it. $900 is plenty to build real positions across several companies, which is exactly what Eli does. Second, time matters more than the size of your first deposit. $900 invested in your 20s and left alone for 30 years can outgrow $10,000 invested at 55. It's not about how much you start with. It's about how long you let it run. Third, think about what $900 actually buys. A car payment, a weekend away, a new phone, all of it loses value the second you spend it. $900 invested does the opposite. It grows quietly in the background, whether or not you're paying attention to it. Eli thought about the last time he dropped $900 without a second thought. He couldn't even remember what it was on. This time would be different. So what is dividend investing really? When you buy stock, you're buying a small piece of a company. Some companies share their profits with shareholders on a regular schedule. That payout is a dividend, and it lands in your account, whether the market's up or down that day, as long as you hold the shares. One payment alone doesn't build wealth. That's where DRIP comes in, short for dividend reinvestment. Instead of pocketing your dividend as cash, it automatically buys you more shares. Those new shares earn their own dividends, which buy even more shares, and the cycle keeps feeding itself without you lifting a finger after the initial setup. Here's a quick way to picture it. Say you plant a small garden with 50 seeds. Each season, a handful of those seeds produce extra seeds on their own. Instead of eating the harvest, you replant everything. Season 1, you've got a few more seeds than you started with. Season 2, those new seeds are also producing. By Season 3, your little patch has grown noticeably, all without you adding a single new seed. That's reinvestment. It's not magic, it's just math compounding quietly in the background. Eli set his account to reinvest automatically and decided not to touch it. But reinvesting only works if the companies behind it are actually worth holding. So before putting his money in, Eli ran every option through 5 filters. First, dividend yield, ideally between 2 and 5%. Anything sitting above 7 or 8% is usually a warning sign of trouble ahead. Second, dividend growth, which matters more than the starting yield. A company that keeps raising its payout year after year is telling you its earnings are growing too. Third, share price growth. The strongest dividend stocks don't just pay out, they appreciate in value at the same time. Fourth, staying power. Will this business still matter in 20 years? Essentials like agriculture, utilities, and everyday retail tend to hold up no matter what's trendy. Fifth, how the company handled past downturns. Did it keep paying through 2008, 2020, and 2022? A track record like that says a lot. Eli wasn't chasing the flashiest ticker on the board. He wanted businesses still depositing money into his account decades from now. 5 names made the cut. He split his $900 evenly across all 5, about $180 each. No single bet, no one sector carrying the whole portfolio. One was a broad dividend fund holding over 100 established companies, giving him instant diversification in a single purchase. Another was an agricultural lender supporting farmers and rural communities, an industry that holds steady no matter what the economy's doing, since people always need to eat. A third was a rural retail chain selling everyday essentials, the kind of stuff people need regardless of how their budget looks. A fourth was a local broadcasting company, pulling in steady advertising dollars tied to news and local sports. And the fifth was a self-storage real estate trust, the kind of business that stays busy whether people are moving up or scaling down. Together, these 5 gave Eli a blended dividend yield of roughly 3.5%, with dividend growth averaging around 18% a year, and share price growth near 12% annually. He turned reinvestment on across the board and let it run. So what does $900 actually become? In year 1, it grows to a little over $1,000, with about $32 in dividends. Small, but that's how every snowball starts. By year 10, it's climbed to roughly $4,200, throwing off about $219 a year, without Eli ever adding another dollar. By year 20, the portfolio sits around $27,500, paying out over $2,500 a year in dividends. Then year 30 hits, and compounding really takes over. The portfolio crosses $331,000, generating more than $52,000 a year, over $4,400 a month. Eli's total out-of-pocket the entire time? $900. Everything past that, the other $330,000, came from time and compounding doing what they do when you let them run long enough. If this video helped you, share it with a friend or two. Please consider subscribing. It really helps and it means a lot.